Let's welcome in Peter Cardillo, Chief Market Economist at Spartan Capital Securities. Peter, good morning and welcome to the show, and thank you for speaking to us at NDTV Profit. This is Hiral on the side. Whatever said and done with regards to where the US tariffs are concerned, the key question right now is the contraction that we are seeing in the US GDP. The number is coming at 0.3% at an annualized rate in the first quarter, and I think this is the first negative growth for US since the first quarter of 2022. What does this tell you? Because I'm sure the emerging markets are also absolutely concerned with this kind of a number.
Yeah, well, the numbers basically indicate that the U.S. economy is either in a recession or about to go into a recession. Now, of course, all of this is predicated on uncertainties. Since the new administration began with its tariff policies, it's created a lot of uncertainties, and that, of course, is also being manifested in the corporate reports that are coming out. Most companies have pulled back guidance, and in many cases, just simply saying it's hard to predict because no one knows the effects of the trade war, and both on an inflationary aspect and also on a business aspect. So it basically has to do with the tariff situation, and I think if today's employment numbers are extremely weak, by the way, we're looking for a jump of non-farms of about 125,000, which would be substantially lower from last month. But if that number should come in lower than 100,000, let's say around 70 or 65, that would be very troublesome for the prospects of the economy in this quarter. And that means that that most likely a recession has already started. Could it be corrected in the sense that you may not have a long-lasting recession? Absolutely. And I think what we're seeing in the bond market right now is that bond traders are betting that the Fed is going to be forced to cut rates, most likely in June. I do not expect them to cut next week, right. But that's what the bond market seems to be indicating.
Yeah, Peter, point well made. Morning, Alex here, or rather evening where you're at. And the question that a lot of people are asking, though, is how deep will this recession be? A lot of people building it in. You said that it's quite likely that we're either going to see a recession or we're already seeing a recession in the US. And the dichotomy, one might argue, you've seen the Magnificent Seven post numbers, and some of them actually posting numbers that were better than anticipated. Whereas, as you pointed out, so many other companies are pulling back on earnings and not even giving out estimations. So how do you make sense of that, one? And two, what does it mean for emerging markets when the dollar heads higher above 100? Do you think that's long-lived?
Well, let me say this, that I think a recession is going to be very light, a very moderate recession, sort of like a dip-type recession where you go in and you come out rather quickly. It's not going to be long-lasting, and I'm basing that prediction on two factors. One, that the trade war probably will end by the beginning of the summer, and we're beginning to see some hints out of China that maybe they'll begin talks. In fact, it looks like some sort of trade agreement between India and Japan is probably already on the table, and it's just a question of being announced. So I think, if you remove the the threat of a prolonged trade war, then I think the recession will be rather mild. Can a recession be stopped right now? I think that's quite difficult at this point because there's been too much psychological damage done to the economy. And so you would need a Fed to become ultra easing and would have to enact ultra easing policies. And I don't see that because they're just going to want to wait and see what the effects of inflation are. So if you get a rate cut in June and a few agreements announced, then I think it's safe to say that it's going to be a mild recession.
Hi Peter, Soumit also joining into the conversation. On the Indian markets, now if you look at the earnings, they're not as bad as the street was fearing about it. Oil prices are now around $60 per barrel again. And given the fact that the street is expecting, but when it comes to the Trump tariff, it won't be as bad on India as compared to other Asian countries. So keeping these factors in mind, do you see there would be foreign buying would continue into the Indian market? We have seen foreign buying for the last 11 trading sessions. Do you expect that to continue?
I've always said that if there was one nation that is going to escape this, it's probably India, because they basically, from the very beginning, your prime minister, said that he would work out a deal. And so I think that it's very possible that very little damage will be done, and I think India can escape it. But of course, again, it all depends. If there's a prolonged trade war, then a global recession is in sight.